Hello guys, on behalf of DM Tutorial, I welcome you to this episode of my series of higher learning videos. The subject of today's video is financial management and the topic is capital budgeting. Before I start discussing capital budgeting, I would like to say a few words on financial management and how, in what way, capital budgeting is related to financial management. Financial management is the most important segment of corporate management because finance is the bloodline of a business unit. So, acquiring the fund and utilizing the fund in the most profitable way is the most important function of financial management, which ultimately leads the company to earn more profit and to become more competitive and sustainable. So, the functions of financial management envelops procurement of cash or fund, that is what is say determining the capital structure, because funds can be acquired either from equity shareholders, which is called owner's capital, or from long-term creditors, which is called loan capital. Now, after acquiring this fund, the company needs to invest the fund into fixed assets as well as current assets. Thirdly, the cash is the most important element of all the factors of production, and the persons who are responsible in providing financial management service to the company or to the firm, as the case may be, they look after how this cash can be managed in the most profitable way, either by investing in securities or by investing in further big projects. Next, dividend payment is one of the most important decisions of financial management. What is dividend? Dividend is the price of equity capital. That is, the profits are distributed among the shareholders in the form of dividends. So, how much dividend will be paid, when the dividend will be paid, what is the cash position of the company, how that cash position can be improved to pay dividend, or whether to pay dividend or not to pay dividend at all, so that the undistributed profit can be accumulated to form reserve and surplus, which can be invested in later stages when business opportunities come in. So these are the functions of financial management. Now, capital budgeting is basically appraisal of either a standalone project or some mutually exclusive projects to choose the most profitable project using certain tools and techniques, and make necessary provisions for of fund to support the investment. Now, where lies the importance of capital budgeting? Why capital budgeting is so important? You see, there are basically two types of capital. One is fixed capital and another is current. One is fixed capital and another is working capital. The fixed capital is the capital invested on fixed assets to derive benefits over a number of years, and it involves huge amount. Related to it, the finance invested in working capital, in current asset, is the working capital. That capital can be recovered within a very short period, usually in less than 1 year. Say for example, in the balance sheet, you see the asset section is broadly divided into fixed assets and current assets. And the current assets include sundry debtors, inventories, and other short-term marketable securities. Now, all these are current assets because the investment made on these assets can be recovered within a short period. That is to say, the sundry debtors are expected to pay within 1 year, or inventories can be converted into cash in 1 year, or the short-term marketable securities can be sold in the market to acquire cash in a short time. Okay? And also, current asset is basically needed to support the day-to-day running of the business. As a result, the amount involved in current asset is much less comparative to the amount involved in investment of fixed assets. Secondly, investment in current asset is made for short time, for a short period, but investment on fixed assets is made for a long time, and the present cash of the firm is being invested for future benefits. So two things are happening. One is huge amount is involved in financial capital investment, and the investment is done for a long period, and that long period includes certain risks and uncertainties. So, unlike investment in current assets, investment in fixed assets is generally risky, because risk is inherent in business. Now, what are the areas of capital budgeting? Capital budgeting is undertaken by a company either to grow or to expand the firm in some opportune moment, or to improve or increase the competitiveness of the company or the firm, as the case may be. Sorry. So, in order to expand, or in order to grow, or in order to increase profitability, the company or the firm may choose to introduce a new product in the market. And when a new product is being introduced in the market, it needs new machinery, because the existing machineries are producing only existing products. They are not capable of producing any new product. So if the company thinks that a new company with certain improved features or new features comparative to the products available in the market can be produced by making capital investment, that is by purchasing and installing new machineries, then this is a capital investment decision. Secondly, some machineries can be found out to be inoperative, or some machineries may have become obsolete. In that case, the company has to replace those machineries by new machineries. So that is also capital investment decision. Sometimes a company shifts from labor intensive model of production to capital intensive model. In that case, more capital is to be invested on more machineries related to human resources. That is also capital investment decision. So, capital budgeting involves certain steps, and I am writing the steps, and I will request you to look at my copy. capital budgeting. Number one is identify new business opportunities or ways to survive in the market. Sometimes it happens that in order to survive in the market, that means in order to produce as much quantity as required to survive, as much quantity as required to achieve at least the minimum sales amount, the company has to take some capital investment decision that is needed for survival of the company. So this is the first step. Second one is collect and analyze all relevant information about either a standalone project or some mutually exclusive projects. So in the second step, the firm needs to collect all the relevant information about the projects under consideration. Now, what are the relevant information? What is the initial capital investment required? What is the amount of working capital required? What is the life of the project or life of the machinery? What will be the production volume? How much can be sold in the market? What expenses are to be borne to produce and sell the products, etc. What will be the scrap value of the machinery at the end of its useful life? These are the relevant information. At the same time, as I've already said, that future is uncertain and risks are inherent in business, the firm needs to assess all the possible risks and think about risk mitigating measures. So this is second step. In the third step, make appraisals by using suitable management, accounting, or financial management techniques. So, in the third step, the finance department of the company or the firm, as the case may be, needs to appraise all the projects. Either the project is a standalone project or there are some mutually exclusive projects, to choose the most profitable one by using certain tools and techniques. Okay? In the fourth step, the firm needs to acquire cash. So this is acquisition of fund. Now, fund can be acquired either from the fund of the shareholders, that is either from a reserve and surplus in the balance sheet, or by issuing fresh capital, fresh equity capital. So that is owner's fund. Or fund can also be acquired from long time loan providers, which is loan capital. In this stage, the company also decides about the capital structure of the company. Capital structure. Capital structure means the ratio of equity capital and loan capital in the capital base of the company. Both equity capital and loan capital have their respective advantages and disadvantages, and the firm needs to choose in a judicious manner the owner's capital and the loan capital to strike a balance between the two, so that maximum benefit can be derived. Number 5, that is in the fifth step, the firm needs to assess progress of the project and review results. It should be kept in mind that in case of capital investment, generally cash inflow starts after 1 or in some cases after 2 years. So the financial department needs to thoroughly monitor the project and see what results are coming in and whether the results are at par with the forecast made or it is away or deviated from the forecast made. If there is some deviation, then corrective actions are needed to be taken. So these are the five steps in capital budgeting. Now it is very important to remember one thing, that capital investment has a very huge opportunity cost. Now what is opportunity cost? The opportunity cost means the cost of not having the next best alternative. That means if the firm did not invest in any capital project, then the firm could have invested the money into fixed deposit or could have invested the money in some real estate or as the case may be. That is, there are always some alternatives to the project selected. So it has to be seen by the financial department that the opportunity cost is not very high. That means the cost of not availing the next best alternative is not very high. That is, if the firm did not spend the money in the capital expenditure, instead of that, if the fund invested the money in, let's say, real estate, then the profit from the real estate would have been less. The firm has to ensure this. Okay, so these are the 5 steps in capital budgeting. Now, next important thing is criterion. Generally, we consider profit as the most important metric for judging the operational ability of our business. But in capital budgeting, operating profit or net profit is not taken into consideration. instead of profit, cash inflows and cash outflows are considered. Why so? You see, there are certain non expense payment. Say for example, payment of principal amount of the loan. This is not a expense, annual expense. This expense is not required to produce anything. So this is not expense. So this will not come in the income statement as expenditure. This won't come. But this entails cash. Whenever a portion of the principal amount of the loan is repaid, that means a huge amount of cash goes out. In the same way, there are certain non-cash expenses that are included in the income statement. Say for example, depreciation. Depreciation is a non-cost expense. No cash is going out, but it is included in the income statement as expenditure. But since this does not entail any cash flow, depreciation does not affect the cash position of the company. Okay? So this is the reason why instead of profit, cash inflows and cash outflows are taken as criterion in selecting the capital projects. So first, what we have discussed today, what is capital budgeting, how it is related to financial management, why capital budgeting is important, and what are the areas of capital budgeting, and in addition to that, the criterion of selecting the projects. So far, it's okay. For today, it's enough. Now, we will call it a day. Before that, I would like to mention that capital budgeting is a very long chapter, and it is not possible to cover the whole capital budgeting in one video. So I have decided to make 4 videos on capital budgeting, and this is the first one, that is the episode 1 of capital budgeting, which has included only a brief introduction of capital budgeting and how it is related to financial management. I hope you have enjoyed this video, and wait for episode 2, where I will be discussing on the different techniques of capital budgeting. Okay? Thank you for watching. Have a good day.